Hey everyone, welcome in to another daily editorial here on the KE Report. Corey and Chad here chatting with Josef Sachachter, founder and editor of the Schachter Energy Report. Also writes the free report called Eye on Energy, which breaks down the fundamentals, the supply and demand metrics that are driving the underlying oil and natural gas prices. Josef, I want to start off with the oil price because when we chatted last month in kind of the mid portion of November, you were pointing to an oil price down in the 70 region per barrel, and you said that would be a buy opportunity for many stocks. We saw oil drop down into the $67 region by mid-December and has since rebounded by about $7 up into the low 70s. Now, this is also being looked at as a geopolitical issue due to what's going on in the Red Sea and shipping lanes needing to be altered because of ships being attacked. How much do you think this geopolitics out of the Red Sea has driven that pretty quick rebound in the oil price?
Yeah, let's start first with the decline that I was looking for in December. U.S. Consumption was sloppy. We know China's having a lot of problems. So if the two largest economies are showing declines in consumption and inventories are very high in China, so they're not going to be buying easily much more. So that was the reason for me looking for the price of oil to break US $70 a barrel. As you know, it went in December 6, 7, it went down to just under $68, 67.71 or something was the low. And we then on December 7th said this is a great buying opportunity. We sent out an action alert buy to subscribers with 7 new great ideas. 2 of them were large cap natural gas, 2 of them were in the energy service, and 3 of them were in the oily side. 2 smaller companies, 1 larger company. All of those 7, 6 of them paid very healthy dividends. And we thought that was the right time to add them, which we did. So since then, just quickly, because of the Red Sea issues where the Houthis, backed by Iran, were attacking Israeli shipping, they then started attacking other shipping except those that are their friends, i.e. Iranian oil, Russian oil, Iraqi oil, Qatari, LNG. All of those were allowed to go through without any attacks. And they're using helicopters now, like you may have seen pictures, that it's not just, little boats and, a guy standing up with an RPG when the boat's moving, trying to attack. They're now coming in with on helicopters like Navy SEALs landing on the ships and taking them over or attacking them. So it's a different, military approach than they've done in the past. The Americans have said, okay, we know how to take on this. So 43 American, Canadian, British, Chinese, others have gone into the Gulf or into the Red Sea area, and they're now policing it and doing convoy to make sure that the convoys coming through the Suez Canal can get through safely, and with enough warships able to knock down cruise missiles, helicopters, drones. I think that this is going to be a temporary issue, as I mentioned in Eye on Energy yesterday. It could be a couple of weeks, but I don't think it'll be more than that because you can get enough warships in the area. And I think the bottom line becomes if Yemen continues to attack and attacks American shipping or ships designated to China or any of the buyers of Middle East oil, I think the Americans and the allies will attack Yemen and all of the Houthi, bases. And then I think if it gets worse, and I hope this doesn't happen, then the Americans could say to Iran, you either rein in your proxies immediately or you're next.
Yeah, Joseph, it's always sad to see these geopolitical flare-ups, but it does tend to move the needle in the energy space more so than other sectors. But let's also look at the other side of the equation here. You always have OPEC Plus and their members, what they say they're going to do and what they actually do. I know that in 2024, starting in January, they're supposed to cut production by 1 million barrels per day. Whether that'll actually happen or not is another thing. And then how are you seeing the landscape as far as inventory builds or declines?
Well, they've said that they were going to keep the 1.2 million and Saudi Arabia the 2.2 million through the end of Q1, and Saudi Arabia said, we'll keep it through the end of Q2 or Q3 as long as we need to. If you look at the OPEC data, OPEC monthly report, which we did in our last Ion Energy issue, they've only cut 359, not the 2.2. So you've got to remember there's rhetorical barrels and there's real barrels. And OPEC has not met their real barrel target. And at the same time, the United States has raised their production from a year ago by 1.3 million barrels. So whatever demand growth there was in 2023, the Americans alone are meeting it. And in 2024, the Americans are talking about growing production by 300,000. TMX in Canada will add some. But the big growth is coming from Guyana, which is Amerada Hess and ExxonMobil, potentially 600,000 barrels, and then Brazil. So you're going to have almost all the growth in demand of about 1.4 million barrels in 2024 coming from the producers in countries that are safe. And even though Venezuela is talking about saber rattling with Guyana, that they want to take the country over, the Americans have already said, we're doing joint military exercises. You ain't doing nothing.
Okay, so considering what OPEC announces compared to what they actually do in terms of cuts, we've seen that discrepancy there. You mentioned U.S. production. That has reached an all-time high again, but you hear from some commentators that U.S. rig counts are nowhere near all-time highs. How do you balance this, what seems like contradictory information here, where U.S. rig counts nowhere near all-time highs, but U.S. production has been moving straight up here?
Well, the rig count last Friday was for the U.S. was 623, down 3 rigs on the week, compared to 776 a year before, so down 20%. But as we know, production went up to 13.3 million, up 200,000 last week from 13.1, and U.S. production year over year is up 1.2 million. And I think it's just the fact of longer reach wells, more proppant, and we're talking about more sand pressure, and the well productivity is going up. And with the LNG growth that they're seeing on the Gulf Coast in 2024, you may not need to drill as many wells. The drilling time now is maybe half of what it was a year ago because of the productivity, the efficiencies, the fact that the frac crews are staying on site, pad drilling, everything, the efficiencies the industry has done means you do not need as many rigs.
So, Joseph, just to that point, if the rigs and the wells that are being drilled are just more efficient and they're going longer, some of the wells we were talking about before we started recording are 1 mile to 3 miles long. So if they can drill less wells but still have better production, how do you see that setting up as far as the landscape of growth in the companies you follow? Where is the growth coming from? Will it just be longer wells but less of them? And do you think the industry as a whole is investing in growth again?
Well, you've got some companies that have a growth wedge. You've seen Crescent Point, you've seen comments from Tourmaline. Paramount has got growth wedges. A lot of companies still have growth wedges in them, but for those that have some debt because of their acquisitions, like Crescent Point and Whitecap, they're paying down their debt, and then they're going to free up capital for some growth wedge, but also for shareholder returns. And, some are saying 50%, some saying 75% will go to shareholder returns. But the key to me is once your debt is paid down, I still want to see growth. And the reason you want to see growth is in Alberta, the demand for condensate is growing because of more SAGD work, some expansions, in terms of efficiencies at the oil sands projects in the Strathcona area, or in Edmonton, on the east side of the city, there's a lot of new projects coming on, Dow Chemical and others, that will need a lot more natural gas. So both natural gas and condensate have increased demand going in the next few years. And then, of course, in just north of Red Deer, there's a very big Nova Chemical facility coming in, creating plastics, cleaner plastics, and the derivative products. So the demand is going up. And then, of course, LNG Canada comes on in late 24, early 25, and they're going to have to start filling the storage tanks, probably Q4. That's 2.1 BCF. So there's a lot of demand coming on in the next few years that does not require, exports to the States, doesn't require exports to Eastern Canada. And I think that is positive for the Western Canadian Basin and for Canadian companies. A lot of companies, have locked in gas to Dawn or to Chicago. I have a feeling that AECO pricing could end up being some of the best pricing simply because the demand in Alberta is there. And if you haven't contracted it to any of those other markets, we may end up seeing $3-4 gas simply not because of the weather, which right now is very moderate, and that's why the price of gas has come down, but we may see it simply because the industrial demand in Western Canada, especially Alberta, has grown significantly.
Yeah, Joseph, no kidding about that natural gas price. It went almost straight down day after day in November, finally reached a bottom mid-December here, but still way off of where it was entering November. One big takeaway this year from the oil sector, company-wise, was major mergers and acquisitions. The largest that we saw really out of any sector. Do you see the deals maybe have run their course, or do you think, judging by your more bullish outlook for generally oil and natural gas, that we could see even more M&A deals next year?
Well, let's take it in certain area by area. The Montney Duvernay has really consolidated with the Crescent Point and Hammerhead deal. There still is some deals maybe that can be done with privates, maybe some in Northeast BC. But I think that once LNG Canada goes to do the second train, and you have all the other projects get the FID, there's going to be another consolidation phase because the owners of those LNG plants do not have enough natural gas that they've got in their own lands. They're going to want to consolidate the energy E&P producers who hold Montney lands. And, we've talked before about Crew, you've got Birchcliff, you've got Kelt, you've got, and then you've got the big ones that, Whitecap has become a bigger player. You've got Crescent Point now, ARC. We've seen even, Tourmaline, Mike Rose's companies in the past, Berkeley, Duvernay, get taken out by the international majors. So I don't think that the merger mania for Montney Duvernay is over. It's just going to need FIDs, and then the guys who are doing it say, oops, we don't have enough gas, and we're going to have to get out there and buy it. If you're looking at conventional oil plays, the Cardium, the Saskatchewan, southeast Saskatchewan, southwest Saskatchewan, the Clearwater, those areas are consolidating still. We're going to probably see more deals, and I think that companies that want a growth wedge, as some of these bigger guys focus on the Montney Duvernay and sell off non-core assets, you might see more sales by guys like Tamarack or Baytex or others. That would provide opportunities for the guys in those areas to become more efficient and coordinate and consolidate the infrastructure and lower their cost structure and continue to find more oil. Again, we're not running out of oil. We're running out of cheap oil, and the guys have to find efficient, cost-efficient ways of getting at it. And between seismic, fracking, long reach horizontals, the industry is doing what it needs to do to bring on economic wells in areas that some people say are tired.
Well, Joseph, another thing that we've had some questions on, I've seen some people discussing this on different chat forums, is the disconnect sometimes in how company or equity prices move versus the underlying commodities. What are you seeing when you look at either oil or nat gas as far as some of the better disconnects that could be a contrarian opportunity as far as how the companies are valued now, and some of them have pulled back a lot where maybe the underlying commodities haven't as much?
Yeah, I think that there's a disconnect right now. Stocks are exceedingly cheap. Many are trading around PDP. That deal that Pinecliff did, Certus, was bought for less than PDP. So you had all the probables and all the wells that were not in because they weren't active. So there was a lot of inventory that they picked up that they can add if they want to spend more money. So I think that there's a big disconnect. When we do see the year-end NAVs, the NI 5101, the reserve reports by the reserve engineers, I think we're going to see a lot of companies trading at a third of their NAVs. If that's the case, then I think we're looking at a disconnect that if companies change from return to shareholder mode to a growth mode, at that point we're going to see that arbitrage tighten up. But I think it may require a change in government in Ottawa as well. I think a lot of companies are being reticent to do the growth mode if they're smaller or medium size, because they're not just seeing the upside in LNG, which is why those deals happen. But the other deals may want a change in politics so that companies understand, that Ottawa is not trying to put a death bell on this industry.
Yeah, we'll see what kind of changes in politics we even see out of the U.S. next year as well. But to your point there, Joseph, all these companies do seem laser focused on returning capital to shareholders. But there are some growth avenues and some companies that have done some M&A activity that gives them a bigger production outlook throughout the next couple of years. Those are the ones I know that we like to focus on a bit more. But hey, overall, around $70 a barrel price for these energy companies. They're still doing pretty well and making a lot of money and returning a lot of that to shareholders. Joseph, thank you as always for your time. It's great having you on this show. We always appreciate your comments on the oil and natural gas sector. We will continue to chat throughout 2024. I hope you have a very happy holidays and a very happy new year.